Good afternoon, everybody, and welcome to Live Market Analysis Macro Edition. That's where we do overseas stock indices, commodities, foreign exchange, crypto, bonds. It's all the big picture stuff, but more importantly, how that big picture stuff affects your portfolio, and it's doing quite a bit of that at the moment. The agenda for today is actually quite simple. It's over to you. Ask the questions about the big macro picture items that you're interested in. I'll give you my best technical and fundamental where possible. But whilst those requests, I can see many FX requests are rolling through. If you'll permit me to do it's become a bit of a customary whip around the grounds at the moment. We'll kick off with the NASDAQ on the charts there. And zoom in clearly. The trend is beginning to change, and I deliberately use very sort of soft language here. I don't think it's the beginning of the end at all. We're just not there yet. It could be. It absolutely could be the beginning of the next bear market, and I won't know until I see further signs to tell me that. But as long as the long-term trend here remains up, and there's a substantial lag, you have to understand, in any technical analysis, but particularly when you're using longer-term averages to, even though they're exponential to denote the trend, there's going to be a lag there. But that's why we don't just stick with the long-term stuff. We've also got the short-term stuff. And we can see here the short-term trend, and if you're wondering what they are, first time a listener to me, 21 and 34 EMAs for the short-term trend, and then 144, 233s for the long-term trend. And that is why we have the short-term trend, because we can see that is turning and giving us an indication that something's wrong. But even then, there's a lag, and this is where the price action comes in. So you can see me sort of drilling down shorter and shorter term to give me clues as to what ultimately demand and supply are doing in the market, because really that's all technical analysis should be. Good technical analysis is simply about understanding the balance between demand and supply and how it is changing. Good technical analysis is not about prognostication. It can give us an idea of how we want to act to place ourselves in the best position for what might happen next, but it is always what might happen next. We never know what's going to happen, and a good technical analyst absolutely abides by that, and that is their religion. I don't know what's going to happen next. A bad technical analyst, in my opinion, tries to predict what's going to happen, and I just think that's foolhardy, as the market is probably going to prove you wrong most of the time. But I digress into the philosophy of technical analysis, and I'll bring it back to what we can see here. And the key of what we can see is whilst those moving averages are quite slow, and I guess the benefit in using those moving averages is the colors they can provide for us. So double green, we know we're thinking about longs. Double orange, we know we should probably be out of the market. Double pinks or reds, we're looking for shorts. And when we get a mix of orange and green and orange and red, again, we should be thinking about a trend transition. But the key for me, and I did this 2-3 weeks ago, I can't recall exactly, but we did track this very clearly through here, the changing of the price action. That is all one line down there, quite certain. And we had the evidence in the market here. That's clearly a point of supply. Obviously, the price was rising up to that point. It started to fall after that point, and therefore, by definition, there must have been excess supply at that area. And then we had the lower point of supply, which gave us an indication that not only was there supply in the market, we'd finally found the supply after that wonderful bull run, that it was indeed building in the market, and that was our concern. Just concern, no action required until we cracked beneath the point of demand through here, and it was at that stage that we enacted a hedge position on the NASDAQ, where we took out a short position. I think it was, I don't know, around about that day there. You can see here how the market changed ahead of all of the rhetoric, ahead of all of the media fear, uncertainty, and doubt. The fingerprints of supply, of excess supply, were in the market. There hasn't been anything substantial in here to suggest that the price should not continue to fall. This was the big day. Actually, I thought that was quite an interesting point there. Is actually coming in at a potential little point of demand here from that low there and that low there, but just wasn't sustained. It would have been good to see a follow through day, and it probably would have precipitated more of a rally, but that day there is the killer. This one here is the absolute killer, and no surprise last night that we're coming down. Where could we go? Well, it's just a matter of looking for the next areas of potential demand, and we say that past points of demand may not even should, but may act as future points of demand. But that is a big question mark. We won't know if it will until we get there, and the get there is some white candles or some lower shadows, much like we saw here. But that doesn't, again, guarantee that that demand point will hold. We want to see confirmation, and really looking into the future here, it will not be until we see this sort of a pattern on the NASDAQ that I can go back to a more neutral stance. I guess, look, we're at neutral, but that we would even contemplate starting to unwind some of that hedge position. So I think you remain short on that NASDAQ hedge if you did happen to take it out. If you didn't, look, is it too late? I think this is a pretty significant point of demand. Look, I'm going to say it's perhaps a little too late until you saw maybe another peak and then another failure, and it could be around here if we don't see that price action, but you saw something that sort of moved into there, and in that case you could be looking maybe to reset a hedge up here. But no, I'm going to say probably too late, just on the significance of this point of demand to enter new hedge positions. But there's nothing stopping you from getting out of long side risk and winding that down. And I think it was 2 weeks ago, perhaps to this day, that we said that we would prefer to stop adding new risk to the portfolio, just being quite conservative. I think letting trades come out and just not replacing them, and just moving more and more to cash where possible. I think that was a pretty sensible thing to do in hindsight. Having a look at some of the other indices here, we have, I'll just go through some of these US ones. Dow Jones Industrial Average, you can see they're making a similar pattern. So not as advanced as the NASDAQ, but that's why I watch the NASDAQ, ladies and gentlemen. I watch the NASDAQ because it is the most sensitive to the macroeconomic challenges that we'll go into in a second, but Dow Jones least sensitive to that because it has a higher yield, but still looking quite forlorn, isn't it? I think we could see certainly a move back into maybe 34,589. And in all cases here, the long-term trend hopefully will support. Russell 2000, far more advanced, also another very sensitive market, high beta market. And this one didn't really give you much of a signal. Okay, there's a little one in there you can see. We didn't track this one forward. We focused on the NASDAQ, but there actually is a little lower point of supply in here and then a break of the point of demand. So if you were attentive to it, you certainly could have picked that up, but then it's all one-way traffic from there. Would love to see this area here at 1860 hold, and I think it is crucial. We don't want to see this sort of a move down. It would just unravel too much of the good work that the bull market has done, but we are at risk of that. So you can probably tell from the tone of my voice, I think we need to be a little bit circumspect here. S&P 500, not as clear-cut potentially as the NASDAQ, and that is why I love the NASDAQ. It just gave us that really clear signal, 43.85 to 43.28, potentially where we might see some white candles, lower shadows come in. But as long as the candles keep printing black, and as long as they keep printing with upper shadows, we remain in a bit of trouble here. That's the equal weight doing worse. Obviously, as you move out through the risk spectrum, it gets worse, and that's not a good sign in itself. If we look at the small cap index, a bit like the Russell, and then the banking sector there, that a very hot space from March, that is starting to unwind again. So I don't have any good news for you. You could say that the fall in the SKEW is good news. I don't believe it is. I think, I touched on this idea when it was occurring, that potentially the SKEW was going up with the NASDAQ, as it was. There was a very high correlation there, positive correlation, simply because fund managers felt that FOMO. They were concerned that we had seen the bottom of the bear market, that the new bull market had begun. They needed to get some cash in, but they were nervous about the global macro. And as a result of that, the fact they had to get the cash in, they were hedging themselves with those far out of the money put options. And you might have heard some press about Michael Burry of the Big Short fame has taken out some options. He also runs a portfolio as well. So some of those options may be partially towards hedging that out, which is what fund managers do. They go long risk on one side and then they short risk on the other side. And we can see now, probably proven right here, that the SKEW is falling in unison with the NASDAQ and not going the other way. So if there was about to be a global calamity, we would expect the SKEW to be rising. It just isn't. the VIX is rising. They are your closer to the money options. They're just demonstrating that volatility is in the near term increasing. That is quite clear. Let us quickly then just look at some of the other jurisdictions. So in Europe, it doesn't look as probably as bad as maybe the US. Just looking there through the DAX, the Stocks 50. FTSE looks more like us. I think they've got some issues there. Obviously, their market is a few big resource companies as well, and banks. So similar issues there. And Spain, perhaps not as bad. Where is the problem coming from? Well, the Hang Seng making new 2 or 3 month lows as well publicised. You already know this. I don't need to tell you. Problems in the Chinese property sector continue to linger. Country Garden is a company there that is at the forefront of that issue. It has missed a few bond payments now. In fact, some of its bonds have been suspended from trading. Never a good look. We also saw very slightly weaker month-on-month declines in property prices. I know the media did beat that up because they tend to look at year-on-year losses, but we know those year-on-year losses have been tracking substantially lower. But month-on-month, we are seeing some slowing in the pace of the declines there, but the media won't report on that because that's not as bad. Nikkei is actually probably going to crack. That's a very interesting chart, isn't it? Not necessarily one for me to short, simply because the long-term trend is still very much up, but you can see that we have clearly broken down through that short-term trend, and the price action is cracking through that trough there. Going with some of the Chinese indices, we're seeing the Shanghai Composite break from stimulus hopes through here back to just realization that things aren't going so well. We had a batch of data during the week: industrial production, retail sales, employment, all moving in the wrong direction. And then we saw the statisticians in Beijing tell us that they are no longer going to release youth unemployment data, which is not a great look at all, is it? The data tends to be a little bit rubbery out of China anyway, and then when you just don't do it, that's not a good sign. This is the key chart to watch: to start stocks that are bought by Chinese people in China, and also moving back towards the lows. If you're wondering why your portfolio is taking a beating, we're starting to get to the heart of it now. We've obviously looked at the damage, and this is why the damage is occurring. The world is concerned about what's happening in China. The China Mainland Real Estate Index, actually not that bad, surprisingly so, but the Hang Seng, this is a much narrower index where I think many of the problems are concentrated, moving back towards those lows again. Let us, I'll skip Australia for a second and we'll look at some of the problems here. And we're continuing to see rising interest rates in the USA, particularly at the longer end of the curve. So the 30-year T-notes there were up at about 4.4%, which is nudging 4.4%. And then as you move a little bit shorter, you're getting into the 4.3s on the 10s. And the 2s haven't moved as much, but they're still nudging back towards 5%. And look, it doesn't really matter which end of the curve is going up. That's not good for stocks. Stocks don't like rising interest rates. I've explained to you this many, many times. We've looked at these charts many, many times, and I've warned you about these charts and the implications of them. But particularly, I think when those long-term yields rise on the back of partially Fitch downgrade, partially greater issuance by the US Treasury, because Uncle Sam needs to pay its bills, and therefore it needs to create money out of thin air, doesn't it, by borrowing that money in these T-bonds. That means the yields need to go up simply from a supply-demand perspective. Partially, it's also the realization that maybe the Fed will keep rates up around these elevated levels for quite longer. We had some, I'm going to say, skewed towards the hawkish side Fed notes from their last meeting released last night. The other, you might have heard this term, real yields are rising. I did touch upon that in a couple of tweets earlier in the week. My job, I feel, is to translate some of this economic jargon into plain English for you to hopefully understand, and then something that you can keep an eye on as we go forward. But real yields are simply the interest rate minus the inflation rate. What you get left, what's left is your compensation for the time value of money, and this is one way to look at it here. This is the 10-year inflation protected yield, and that's moving towards 2%. So we'll often use this as a proxy for the real yields, and then you can look at it over different timeframes as well, and about 2.2% there on the 5 years. And the implications of this is nothing really kills economic growth better than real yields, high and increasing real yields, because it just sucks capital out of risk taking. The opposite is negative real yields, and that's what we had for so many years after the GFC, where interest rates were almost zero and we're still running at inflation. So the incentive there is to spend, is to spend now. The incentive now is to save, because you are getting these high and rising real yields. We talked about obviously these high long-term rates, and the incentive is to lock your money away risk-free and not have that circulating around the economy. But to some extent, that was central banks' aim, to try and really just suck the life out of risk-taking and expenditure to combat this inflation. I would suggest they're pretty much on the right side of it now, and there's two ways they can go. They can stay the course and really choke this inflation to death at the risk of, and this is what we're seeing factored into markets over the last couple of weeks, really killing the recovery and killing stocks. Or they can back off a little, let this recovery continue to percolate, continue to develop, and risk maybe a second pulse of inflation. And I think they're going to go the first way, not the second way. That's just some of the language that I think, particularly the Fed is using. Our Reserve Bank is rolling over, I think, going the second way. Good for us in Australia, but unfortunately, the old saying is when America sneezes, the world gets a cold. And talking about getting a cold, let's have a look at some of these base metals prices here, because to use a really terrible metaphor here, what's the right word? They're at the coal face. It's the saying, isn't it? They're at the coal face. Well, we're going to talk about coal literally in a second, but aluminium, that's not exactly screaming global growth, is it? Certainly not screaming great things are happening in China, and we're growing more and more desperate for some meaningful action from Beijing. And really all we got yesterday was a 15 basis point cut in one of their minor lending rates. The main lending rate is still unchanged, but there probably will be some movement on that at the end of the year. There's only so much Beijing can do when they effectively, their economy is one big great ball of debt anyway, and there's only so many bridges to nowhere and dams in the middle of nowhere that you can build in terms of infrastructure as well. And that's why we're seeing copper starting to roll now, and actually concerningly so. And there is a little bit of a low here. I might move to my other charts here, because I've got my levels on there, and just change some of these things around. But yeah, 79.10. Wouldn't want to see it get beneath that, because it pretty much kills this, I wouldn't even call it a rally, but this stabilization in prices. And beneath there is very slippery slope back to some of those post-Ukraine lows there. So that is disappointing. What does the high grade contract look like? Not much better at all. That's the COMEX contract. Iron ore in China won't appear until I do something. And then it will appear. There it is there. And that's really iffy as well. So through here, we're going to have a problem on iron ore. I know I'm depressing the hell out of you, but hey, don't shoot the messenger. That's the Shanghai version. I wouldn't say it's all that much better. Let's go to nickel. Again, we're just doldrums, isn't it? Lead's not so bad. Tin has broken down, and zinc also has broken down as well. The only thing still going up is uranium. For the uranium bulls, not to say that uranium stocks dodged the latest bullet, didn't they? We got excited. I warned you. I put a bunch of them in my shortlist, and I told you, I said, look, you're going to be disappointed. The charts look good, but you'll be disappointed again, lo and behold. That brings us to lithium hydroxide firstly, and that has broken down again. No surprises here if you've been following me now for months. I've been concerned about the possibility, and the reality is that the short-term trends have re-exerted in line with the developing long-term downtrend. I don't know. I mean, was it I think it was quite prophetic, but did it help you in terms of profit? I think our Aussie lithium companies have held up pretty well, and there've been a bunch of little ones that have shot the lights out here and there as well. But then, I guess you've still got your cores and your say owners as well. But hey, how much is any of that linked to what we're seeing on screen? What I can say is, it's a bit of a dead weight, isn't it? I mean, how do you get excited? How do you build the next bull market, particularly in producers like your Allchems and Pilbara's and Mineral Resources, when one of their key underlying commodity prices is doing that, and that's the lithium carbonate. It doesn't look as bad, I guess, because it hasn't taken out that low in April, but in terms of percentages, it is actually falling a little bit faster. And one I've just started charting actually is spodumene concentrate. That's all the data I've got on file, but that also is heading down at a rate of knots. Sticking with the idea of sort of growth-related commodities, somehow coking coal continues to rally. I'm not sure if I've got the latest price there, but it's not that old, to be fair. It has been trending higher, and this is the latest price of Newcastle coal. Thermal coal prices starting to improve, actually, starting to look half interesting there. A little bit of an inverted head and shoulders, dare I say. And of course, I've put in New Hope on the shortlist. Natural gas futures got a bit of a pop. I got excited, and then down they come again in Europe, where there is more sensitivity to what's happening on our northwest shelf with those Woodside potential strikes. It has stayed a little higher, but that looks like a flash in the pan. And to be honest, it probably wasn't anything to do with the strike. It was just the fact that China has deteriorated. That's not the latest price. Let me show you the latest price on crude oil, which is coming up on your screen in just a second, and probably heading off a bunch of your requests in us anyway, but this is crude oil coming up here. It started to look very good, wasn't it? China is the problem. They're pulling back, but not substantial, but it could get a lot worse. I mean, it's just hard to see anything really until we get that risk on spark going again, pushing much higher. I mentioned I didn't quite have the latest price on coking coal, but you can see it. I had a recent price there. Natural gas in Europe isn't as bad. It has not pulled back as much. Let us quickly just shift back to here and look at the gold price, and then I will head to your requests, because I think that's a pretty good whip around the ground. In fact, I'm going to go here and talk about the US dollar, because I should have talked about it when I talked about those rising yields. And if US yields are going up, there's only one way this can go. There's no other way it can go. And we are seeing, therefore, the substantial improvement in that US dollar. And it all just pivoted, didn't it? It all just switched. And that is how the macro works sometimes, ladies and gentlemen. So either get in the picture or sit there and wonder what the hell happened to my portfolio. And hopefully you agree that's why we do these sessions. Let's have a look at the gold price here. And the other upshot, of course, of those rising long-term yields is gold is, and this is the technical term, stuffed. I mean, absolutely stuffed. You couldn't have a worse set of scenarios here coming out for gold. The only reason why it's probably not down below, that's silver. Anyway, ditto for silver, right? Silver's stuffed, by the way. I've just clicked the wrong one. The only reason why it isn't lower, and if I go to gold, why gold isn't low, but it looks like it's about to really, really crack here, is this the uncertainty. That just general gold is this thing you hold in uncertain times, and there's probably some demand in the system preventing it from falling further and faster. But looking at that chart, it could well be not that far away. Given that we are breaking through the long-term trend zone here, I could actually contemplate some shorts on gold, and maybe we can investigate those a little later on. I haven't done the Forex. I haven't done it deliberately, and that's only because I want to take your Forex questions. So that's the whip around the grounds. Hopefully that was worth something to you. If you have any questions or you want me to expand on any of these concepts, certainly let me know. But I'm going to head over to Perry's requests now, and we're going to look at the GBPJPY first. And I'm just going to change. No, I'm on the right watch list. I'm going to head down here, GBPJPY, and this has been going very well. Did we put a little trade on this last week? I can't remember. We did the Swiss yen maybe instead. I know that one's been going for a while. We did the GBPAUD. I'm looking down here, so there's the NASDAQ. There's the NASDAQ short trade, and we did 0.3 of a contract there. You can see just 0.3 of a contract Obviously, we nailed it. I mean, we shorted it at just the right time. But for just 0.3 of a contract, that's a $210 profit. And I just want you to contemplate, and this is not an I told you so sort of thing, because that's not what these sessions are about. These sessions are about inspiring you and educating you to what to do next time. But I can't remember how much we were risking on it, but I think it was like 70 or 80 bucks. Risk to hedge out some of your portfolio. And you could have gone bigger if you had a bigger long side position on US stocks. But and of course, if US stocks kept going up, don't forget this would be showing a profit. But it's finding the balance between, well, I understand that's what a hedge is about. Hedge is insurance. If I crash my car, I don't go to the insurance company and say, how dare you charge me all of those premiums over those years? I'm just really glad that I had that insurance in place. I digress. I thought we did the sterling yen, but it seems we did the sterling Aussie instead. But that looks great, Perry. I can't see any reason why you can't continue to go long that. Let's look at some of the reasons why, and the reasons why are embedded in what's happening here with our yields. So if we look at the Japanese yields, and we'll stick to the short-term yields, they have been going up, to be fair. But then we look at the sterling yields, and I was going to say they've been going up more. Well, there you go. They had, relatively speaking, they have been going up more. I know the chart doesn't look like much, but don't forget, look at the scale. Look at the scale, ladies and gentlemen, 0.02. Okay. And so this has gone up here from 488 into 520. So it's just, make no mistake, there's a substantial change there. But that is powering that FX trade, as you can see, because FX trades are really all about relative yields. And if you get more yield by in one currency than another, the incentive there for the big fund managers, and they don't do this on your $100 or $200 a trade, or your $1,000 or $2,000 a trade. They do this on millions and millions and tens of millions of dollars, so it's worth their while. But those small interest rate differentials can really add up. So they'll borrow in yen, they'll go to a Japanese bank, they'll borrow a bunch of yen, and then they'll invest it in something in the UK, probably the UK bond, if you get what I mean. So it's a risk-free investment to then service the debt that they have in yen. And if fund manager A does it, fund manager B does it, all the way to Z. Can you imagine how many people, how many big fund managers are doing this and just creaming off that carry? It's called carry, okay? It's called the carry trade, and it's called positive carry because I'm using a bit of terminology here. There's the overnight swap rates favour or payoff to the holder of the sterling. So yes, with the positive carry, I can't see any reason why this can't continue to go higher. It's a great trend. Short-term trend is up, long-term trend is up. This is white candle after white candle after white candle. We're back into high peaks and high troughs. It's a little bit of a ways away from the light green zone, but I can't see why you couldn't do it. And given that we don't have it yet, I'm going to put it on only to demonstrate how to do it. So GBPJPY, just type it in here. This is our ThinkMarkets trading platform. Everything we see here is a CFD trade, by the way. If you don't know about CFDs, it's time to learn about them. And we make sure we click the buy button because that we're looking to go long. If we click the sell button, the platform will think that we want to go short. Okay, if you've never gone long, so if you've never gone short before, you don't need to worry about it. If you click the sell button to start the trade, right, you are going short. If we click the buy button to start the trade, we're going long. It is that simple. And then it's just a matter of, for me, getting my position size right. I'm going to start with the minimum because I just want to show you at the minimum position size what the risk is. And now I drag my red line down to get it to a point where I'm comfortable that my initial risk, that is if we saw a huge black candle that it closed there, it would just take me out. All right, that sort of hard stop, that point of no return where I'm going to let the computer take me out of this. Now, more than likely, before this occurs, you know my system, you know my model, we're going to see black candles, we're going to see a lot of points of supply, we're going to see other stuff to get us out of it. But I just like that peace of mind, knowing that I've got that protection. Now, why am I putting it here? Well, this point of supply, this old point of supply, I don't know, I expect it to add as a point of demand. It's a point where the price, if it comes down, should bounce off, bounce off. And if it bounces off that level, then my stop is protected and safe. Here's another level here. Okay, there's a nice little candle here. What's that low? Let's say if you're unsure, you just click on that little button and it gives you the low. I'm going to go that low there is 182.69. I think you go very tight under that candle. It's like a 182.59. So let's go, oh, we're actually not that far out. 182.5. Just got rid of the decimal point, so it didn't like that. And there you go. So that's how I'm going to set up the trade. Now, if you go, well, Carl, I can risk more than $38, then it does facilitate, if you'd like to follow my model, to tick this up to 3,000. I know that's going to go a bit wonky, right? But now with triple the size, we obviously triple the risk. You say, oh yeah, look, I'm pretty cool with that. Actually, $115 sits well with me. Or it's too much and then do less. Or you know what? I've got a huge account and therefore I can take much more risk than that, Carl, and I'm going to do a different number here. Okay, but the idea is, well, what am I doing? Am I going long or short? I'll tick that box. Where should I put my fail-safe stop loss to determine my maximum risk? My actual risk should be less than that because my model will get you out sooner when you think about it, right? The reason why I'm doing 3,000 is because it allows me to get out in thirds. Okay, and there's nothing left to do. Part hit, obviously click that button, click confirm buy now. I don't put a target in. I never put targets in. That's just the way I do things. You can if you want. Place the order, and that order is created, and it should appear in our list down here, but it will appear initially as a loss, and that is a default because there is a spread involved in all trading, and we start out as a little loss, and that number will fluctuate. I suggest you don't watch that number. The worst thing you can do, ladies and gentlemen, is sit there and watch these numbers. Please, please, please don't waste your life doing that. I know it's tempting, but it's the worst thing you could absolutely do. So we've now look at that. There you go. Let's sit here and just watch this for another 30 seconds because it'll make a big difference. It won't. That was sarcasm. Anyway, that's how you could do it if you wanted to do it. Let's head back to here. Where am I going? Back to here. So thank you for that one, Perry. Perry's also got GBPAUD, which we did do last week, didn't we? And that's going, well, there you go. And okay. So what? You got it right. Well, it's about the methodology. It's not about the result. It's about the methodology. It could have gone the wrong way as well. But hopefully you understand the methodology in that the short-term trend was up last week. The long-term trend was up. The candles were good. The price action was good. And I think we're choosing between maybe that and the Swiss Aussie, and we chose to go with the sterling instead. Hopefully that was a better result for whoever asked it. Perry, do we need to do anything with this? No, I don't think so. The candle's heading the right way, so there's nothing left to do. We probably could have added a little bit more risk as you went through the position, through the candles. Where does the stop go now? Maybe we can just investigate how to trade the stop loss. So let's go. We've seen and this is why I like to do these demo trades, so we can come back to them and we can say, okay, well, that's going all right. What do we do now? So if I click on that, it actually opens up the window. If I click on this, this is going to, oh, here we go. This is our stop loss here. So we click on that, and it shows me where my current stop loss is, which is all the way down here. So I don't know if you caught what I did. I'll do it again. I click on my position. I click on the stop loss. It puts the chart up, and now I can raise this. So where am I going to put my stop loss now? And this is my fail-safe stop loss. I can use other methods that I teach to get out. But you can see here, if I go up to here, I'm beneath that point of supply, which should now act as a point of demand. I'm beneath that point of demand. I'm beneath that point of supply, which acts as a point of demand. I'm not too fussed about those candles. I'd probably go a little tight. Or if you were a little bit risk averse, maybe you just want to sneak in under those. But I think that's overkill. But anyway, let's leave it there. So you can see that the system, I just have to click modify now. It's actually put this in for me. I never go 205, I go like a 19 or a 17, never use round numbers. And therefore I click modify, and it will change that stop loss for me in the system. Now there is the new stop loss there. Okay. So my entry price here is 194.62, and now I've reduced that risk on that trade substantially. Okay. No reason for me to do anything else on that one at this stage. Let's keep moving. Let's head back to here, and we're going to look at Perry's third suggestion, which was GBP NZD, which is probably going to look very similar. In fact, it actually looks better, doesn't it? So happy holder there, Perry. Could I buy it today? I don't mind. It's a long ways away from the light green zone. It just means that there's potentially an increased chance of some mean reversion, but I can't fault it. It looks great. Today's candle is still live though, isn't it? I mean, the buy would have been at the open of this candle or at the close of the last candle. So keep that in mind also. Today's candle is live. I don't know where it's going to finish or how it's going to finish. If it finished with a black candle, then I'd be less interested. But otherwise, ditto on this one. Ditto for everything I've said on the first two on this one. They're ultimately very similar trades. You have to admit GBP AUD and GBP NZD are going to be very similar trades. So if you're taking both trades, understand that you're going to win on both or you're going to lose on both. Okay, so if you go, oh, I've got $100 risk on this trade and $100 risk on this trade, really, you've got $200 risk on this, on effectively a slightly different trade, if you get where I'm going. Let's go to, Perry's got one more, CHFJPY, which I think you also saw in the system. It's one we put on a few weeks ago. Let us try the stop on this one, just for demonstration's sake. So that's in here. I can then, see if I click on that, it gets me to the chart. But then if I click on this, it gets me to where my stop loss is. No point leaving my stop loss so far away. Obviously, you're not going to do this every few weeks like I'm doing here. You're going to do this every day. You're going to come in and check and see if there's an opportunity to get your stop loss closer. Now, you could go there. I think I can go even closer, actually, because I can see this big candle here, this big demand candle. For me, that is as good as a trough. That is a point of demand in itself. And I've got a couple here as well. But maybe let me just sneak it in under that one, just to be safe. And that's like a 163.27. I'm going to go like a 17 then, which means now, look at that. So when we did try this last stop, I still had a risk component there. It was a red number. Now my potential loss is a profit. So it's just a function. This trade's been going for a bit longer and it's in more profit. So when I try my stop loss, my worst case scenario is to have a profit, and they are my favorite trades by far and away. So don't worry about the quantities here. They are irrelevant. They're just me doing just the minimum amount, and don't even worry about the trades. They're just, I'm not trying to prove anything to you. It just is. I can't change stuff anyway. Now, Perry's looking for some shorts as well. AUD USD, which I agree with. I did run an article on that yesterday or the day before, and then last week as well. It was around this candle here, which I felt was the key to this puzzle here and going short. So if you short that one, I would stay with it. I don't think we did put it in the system. No, we didn't put it in the system, but that's okay. I would stick with that one, and I think you could get towards 61 sort of 90, and maybe you just want to go just above 62 to take some off the table. So I would take a third off the table, Perry, simply because this is an almighty point of demand. I know I'm on top of it, but an almighty point of demand here that you should be concerned about, and sort of like a 62.20 or a 62.30 to knock some. Don't wait for the low of that. Don't try and get all the way down to the low. All right, that's where everybody else is going to be buying back their shorts. Okay, so you just want to take some off the table before they start buying. Okay, because their buying is going to push the price up. That's bad for your short trade. So you want to start buying before they do. And I reckon like a 62.30 would be the place to start to take some profit on that one. If you're not in it, risk reward, I'm not sure if it's completely there when you think about it. So it's one you would have to be on. AUD CHF, I think we talked about CHF AUD, and then we ended up inverting it. I don't think, did we do that one? Oh, we did do that one. There you go. Okay, good. This is good. So I can actually follow this up for Perry. So again, clicking on the stop loss, it shows you where the red line is. So where can we go to now? I think down to here is probably a good place to do it. You can see there's a little trough here. So keeping the stop loss above that trough, that old point of demand should act as a point of supply, or you could be a bit conservative and go above this huge red candle, because that's a clear point of supply as well. But then we've also got this. There's a bunch of them. So I don't think you need to be any closer than that. In fact, probably I'm tempted to even come down to here. Yeah, I think we can come down. There's a fair bit of work it needs to do to get back up there. So let's go here. And that would be a 57.79. Now, like I don't go round numbers, I'm going to go like above here, 83. I'm clicking modify, and I didn't see what that took it to, but I can check here. It's still it's a small loss. So you've only got $25 risk now on that trade for the position size we did. It's really great follow-ups there. Thank you, Perry. I did forget to do the ASX 200 Nick. I'm going to do that for you now. Another Nick from ThinkMarkets is also online. I have to do my streamers as well. I'm going to get to you in a second. I haven't forgotten you. But if you are in the Zoom session, it is probably the better place to be. You're welcome anywhere, of course. But Nick has the demo account. So if you want to just open up the demo account and just get a feeling. Put on some of these trades we do on Thursdays, see how they play out, get the hang of using the platform. That is the best way to do it. You can put in 100 grand if you like of play money. If you lose, it won't hurt. If you win, we're not going to pay it out to you either. But it's a great way to get to learn how to use this platform. So Nick's put the link in the chat window there. I'll see if I can't paste it across here for everybody. There you go. That's the ThinkMarkets demo account for you. Okay, I'm going to finish off these currencies and then I'm going to go to the ASX 200. So we've got Vincent asking about the NZD USD, which I suspect is going to look similar to the AUD USD, and it is. Maybe not as developed as I like this one. Let's put this trade on. Actually, I think this one looks good. I think there's more in it. So remember, I said on the Aussie one, there's probably less in it from a reward to risk perspective because we're closer to that low. Now, if I'm setting my stop loss, I'm getting in here, and I'm setting my stop loss probably up here. I'm struggling to make that 1-to-1, but this is a very similar trade. And if I'm getting in here, I'm going to get my stop probably around there, and I've still got ages to go to here. So I think this is the one I'd prefer to do. Thank you, Vincent. Let's head over here, and not hard to find. I just go NZD USD. I'll put it on, and that way over the next few weeks we can see how it plays out. Just click on that button to open my ticket there, and I want to get my stop loss. Let's click on that, and let's set a stop loss at say 60.33. So I'm going to go 0.6033, and you can see, and I'm going to tick this up to 3 contracts, and you can see it's something's wrong here. And this is I know, Nick, it was rhetorical. So what I'm trying to illustrate here is this easy mistake that a lot of people make. Certainly stock traders who only know how to go long, they click that, they click this, and it's not working out. Well, look, I'm looking to sell first. I'm looking to short this contract. And I need to click the sell button, and now that starts to work. Okay. Now, if shorting, we click the sell button first. Don't worry about borrowing if this is just how it works. If you want to go short, you click the sell button first to open the trade. By definition, you need to do the opposite of what you did at the start to close the trade. So if you click sell first, you need to buy later. Going long, you click the buy first, you click the sell later. But it now makes sense. If I'm selling down here, I want it to go down, so I can buy it back cheaper. And the difference will be my profit. I don't want it to go up. And that's why this is now stopping my loss, because if the price goes up, I'm going to need to stop my loss. So let's do that. I can go confirm sell. If $57 is too much for you to risk, only do 1,000 in the contract size. That's a micro contract. We have micro contracts. If it's not enough, then risk more. That's up to you. I'm not here to tell you what your risk is, and that should now appear down here in our things, and we're losing 89 cents, 99 cents straight away, because that is the spread. That is always going to happen. Stop watching it now. So get off that screen really quick so we don't watch it. Let us do, that's it. I've done all of those, I think. I've done all of those. Let us go to the streamers now. Streamers want coal and cocoa. Kirsty, I'm not sure if you caught before. I definitely did coal, but let me do it for you again to make sure that I've got it for you. That was the Newcastle coal. As I said, just starting to improve, just starting to make potentially make a bottom there. It's not something I'm going long, although we are seeing a pickup in some of those ASX coal stocks. And coking coal is starting to improve as well. We're seeing some of the local coking coal stocks, metallurgical coal stocks do pretty well. Kirsty also asking for cocoa, which is going to be, that's Cornos down here. That's this one here. So that's cocoa futures, which is a great long-term trend. I'm a little bit concerned about this candle here and this candle here. So I'm not sure if I want to buy that trend. I just think there's too much damage done to the supply side. And I'd be concerned that we're going to lower peak inside this big point of supply now. And maybe this could move into more of an equilibrium phase. So the fact it also closed beneath the short-term trend zone, turned it orange, gets me concerned. I can see why you might be looking to buy it, just on the basis that officially the short-term trend is up, the long-term trend is up. So it's a candidate, but I don't want to see it do this sort of stuff. It's just going to hold me back from buying that dip. in an uptrend when the short-term trend is not penetrated, it is not close below, we don't see huge black candles and upper shadows, you can buy the dip. I love buying the dip. There's a candle there to buy the dip. That's plus 1/3, plus 1/3. That's a plus 1/3. That's a plus 1/3 using my model. That's a plus 1/3 using my model. That one I probably wouldn't do, the shadow, little upper shadow. That one I would do. That one I would do. That one I would do. Okay, I would have had to get out probably a third here and then get back in here. That's just the way it works. Plus 1/3, plus 1/3. Okay, plus 1/3. You can see how my model works, but here and then getting kicked out of some of that risk through here with these black candles. But I don't think I'm adding back in just on that, on the basis of the strength of that supply pulse. From Mike, let's look at Bitcoin now. We're going to go to crypto and we're going to look at BTCUSD, and it's in a holding pattern, isn't it, Mike? I wish I had better news for you. Bitcoin also, a bit like gold, digital gold, it doesn't like it when those long-term rates go up. And yeah, look, that it's definitely weighing on Bitcoin. It doesn't look as bad as gold, and that's encouraging. If I had to choose between owning Bitcoin and gold right now, I would own Bitcoin. That is for sure, without a doubt. But I'm a hodler. I'm a hodler anyway. Honestly, I would never sell my Bitcoin holding. I don't have enough of it really, to be honest, to matter. It's enough that my wife would be angry at me if it went to zero. But it's a modest part of my total financial wealth. But I can assure you, I'm never going to sell it. I'm going to hold that forever. So I'm probably not the right person to ask. But if you're trading it, let's face it doesn't look great. It's holding this long-term trend. It is in a short-term downtrend, but it doesn't look awful either. It's not something I'm going to put on the demo platform to buy, even though you can trade Bitcoin on our platform. Isn't that amazing? You trade stocks, commodities, cryptos, all from the same platform. It is awesome. Ethereum, this is good. Let's look at some other cryptos here. We've got Ethereum here. There it is. Looking a bit like Bitcoin, slightly worse in that it is actually pushing towards that long-term uptrend zone, but it is still a long-term uptrend, thankfully. I also own some Ethereum, but this is not looking great. It's not exactly a buy. Hey, if I take my hodler hat off and put my trader hat on, I would not be long this right now, just right now, okay? Next big white candle, I'd be very interested because I think there's still plenty of potential in this big base pattern that's forming, but just not right now. The only other thing which I have been watching over the last couple of weeks, I haven't looked at it this week, to be honest, because it's not one that I would personally buy, but Shiba Inu was starting to look good. Even that one's flamed out. I know Chainlink was also looking quite good. Not sure how it's gone over the last couple of days. I don't own it. There you go. It was sort of through here. I thought maybe it could bounce off that. It's just come down with everything else. Solana, I thought looked half decent. Again, not a holder. I won't go into the ones I do own because they are absolutely rubbish among quite a few others in here. There's my AVAX, there's my Avalanche. And I've got a few other bits of junk in here. There's my ADA option on ADA, just as bad. I can't even remember some of the stuff I've got lying around in there now. Let's move on. What was the last one I bought? NEAR Protocol. Yeah, there you go. Okay, let's stop looking at crypto because I'm getting sad. I've done all of the... Kirsty saying, hey, Carl, what happens after you've shorted? Okay, let's have a look. Let's go back here and let us go to one. Let's go to one that we have shorted. Okay, look, I'm going to do this. Let's do this one here. Let's go New Zealand dollar, US dollar. We literally just did it. So I'm going to click on it. And if I go maybe here, it'll pull up my order ticket. And how do I just, oh, well, this, sorry, I was thinking, how do I close it? It's just here. I just click X, but I wanted to pull up the order ticket to show the clicking of the buy button, but it's actually not even that complicated because Kirsty, I'm not trying to be flippant here, but anywhere it says sell is a short position. And well, what happens to it? You just click the X and the X gets you out of it. Now, what the X does is buys back your position, but you don't even have to make it that complicated. I click sell, I click place trade, and then I click the X to get out. I take a short trade, I exit out. It's pretty simple. In terms of then adjusting my stop or setting a target, that's where I double click on this, and that's where I can start to muck around with these. Okay. So hopefully that answers the question, but I'm happy to continue to discuss it if you wish. We're going to do the XJO because a few people are asking for it now because they want to be miserable. They want to look at something that makes them sad. So let's do that now and head over here to the S&P ASX 200 index, and I'm going to change some things around. And it does make me quite sad actually, because I was having a great time. I was picking some great stocks. We had plenty of stocks to buy. Earnings were going the right way on some of them, not so right on a couple of others, but generally pretty good. And then just China and those yields, and just you can see how quickly, as I said, the macro can just unravel for you, or unravel your portfolio. It doesn't look great. Cracked straight through the short-term trend. It cracked straight through the long-term trend. Lower peaks, lower troughs, predominantly black candles. It's just nothing good to say about it. The only consolation is ultimately this is still a very well-defined trend zone. I mean, there's actually nothing to see here anyway. So there's just a bit more of nothing to see here. Until it gets below 69.98, I think we're okay. Beneath there, there's still plenty of defense, right? 68.95, 69.05. It's just probably not going to go anywhere anytime soon. The biggest impacts, no doubt, where you're feeling it, the material sector. That's a significant break. That's an important break through there. And that was, a long consolidation phase where you can either, obviously, you're moving up here, you consolidate, and then look, where do you go? And this is Technical Analysis 101. And it appears we're breaking through here, which is not a great sign. We're not going backwards in time. That would be nice, but we're going down here. Sectors, let's have a look at the sectors here. Discretionary, I still think looks okay. I mean, we've seen some of those discretionary stocks pull back up again, but they've hit a level through here and they're having a bit of resistance. Energy was looking good until the China stuff. Financials actually started to look good. The banks started to go back up until China stuff, yields. Gold is not where I want to be, okay, at all right now. Healthcare, we've got a bit of a bounce in Cochlear and CSL. That's that big white candle. Tech actually maybe just starting to roll a little bit in the short term. That's concerning. I've done materials. Property still looks pretty awful. And, I said on the call yesterday, rates kill REITs. Koshi said he's going to make a T-shirt out of it. Staples, I just think a bit ho-hum at this point in time. Telcos, well, that's the Telstra index. Earnings today, I'm guessing, weren't so good. And utilities, that's the AGL index. Literally those two companies respectively control those two indices. I wish I had better news for you, ladies and gentlemen. I don't. And it is what it is, unfortunately. That's all the requests that I have for you. We're getting pretty close to time. If there are no others, we'll move on. Thank you, Perry. No worries. I will continue to do that. I get that from SMM, and I just literally just put it in Amy Broker each day. I literally manually update those and make a chart out of it. So happy to continue to do that. Let us head, in the absence of any further requests, back to the Prezzo, which just reminds you that tomorrow we're going to be picking up the pieces of our US portfolios, which no doubt are looking pretty darn awful. And as I said, it is what it is. We don't get to pick the price after we get in. Stuff just happens. And as much as it might hurt, and that might sound a little bit flippant and a little uncaring, you can cry about it all you like. It ain't going to bring the money back. But hopefully, and this is all you can wish for as a trader and as a technical analyst, hopefully there was enough warning to at least reduce the risk before it got bad. And that is all we can ask for as a technical analyst. We can't expect everything's going to go the right way, but we can hope that when it doesn't go the right way, we get some warning to take some risk out. And my model actively does that. So hopefully you saw the signs. I can't tell you the candles right now. I can't see them, and we'll look at them tomorrow. But hopefully there were some signs to start reducing risk. If anything, that NASDAQ chart was the key piece of the puzzle, wasn't it, to helping us understand what's going on. And the reason why, I know I'm at a very boring screen here and I'm just talking monologue, but the reason why I watch the NASDAQ is because it is the most sensitive index to those rates. And at the end of the day, rates mean everything, ladies and gentlemen. You can't do anything in markets without understanding what rates, the impact of interest rates. Interest rates equals the price of money, and the price of money affects every other asset. Hopefully you enjoy these sessions. Hopefully some of this is starting to make sense to you, and maybe you're going to sound very, very smart at your next dinner party when the topic of the world economy comes up. Register for the Tuesday session, ASX shares at 1 p.m. Obviously today you're here, and then the USA session tomorrow at 1:30 p.m. Very important, slightly different time. www.thinkmarkets.com/webinars. If you're not a client of ThinkMarkets, you should be. I just showed you for about an hour how great the platform is, how easy it is to use. I've sent you the links for the demo platform. I won't go on and on about it, but we are pretty good at what we do, and we have everything you need to trade. www.thinkmarkets.com/AU for details. If you are following me on any of the streaming services, make sure you hit the subscribe button to stay notified of my video updates. I do go live a few times a week, and it's so important that you hit the thumbs up button. It lets me know you like what I'm doing. I'm on the right track. I'll keep doing it. It also lets ThinkMarkets know that I'm creating good content for you all as well. Apart from that, it's been a pleasure chatting with you today. All the best for your trading and investing. Till we catch up again. Bye-bye for now. Before you run away, don't forget that the disclaimer is important. It says that everything we've discussed today is general in nature, has not taken into account your personal financial circumstances or particular needs. So before acting upon any of this general advice, you should consider it carefully or seek the help of a financial professional. The rest of the information, that disclaimer is important. You should read it. Or if you have any questions at all about ThinkMarkets or our products, please hit the website, download our product disclosure statement or our financial services guide, or give us a call. Bye-bye.